Guys, the headline CPI for March came in slightly below expectations, and already the analysts and banks are saying that they are now expecting the Fed to do only 1/4 point raise in May and possibly stop from there on in. And of course, everybody has their fingers crossed that that means rates will start going down. Now, just because the CPI is down for 1 month doesn't mean that inflation is whipped for sure. But what if this next supposed rate increase in May is going to be the last one for a while? Or better yet, what if they start cutting after this because of a recession or another bank blowing up or something along those lines? What do you do if you want to be in bonds with interest rates heading lower? So like I said in previous videos, when interest rates are going higher and you expect them to continue higher and you want to be in bonds, you want to be in as short-term bonds as possible so that you can roll it over and get that higher interest rate that you're expecting in a few months down the line. So conversely, if you really believe that interest rates have peaked or they are going to go lower over a long period of time, you want to go longer out onto the yield curve if you want to be in bonds. Now, I'm not saying interest rates are going higher, lower, or staying the same. That's for you to determine. Everybody has a different situation of what their needs are. But if you do believe that interest rates have peaked or are going to head lower over the long term and you want to look at some longer term bond solutions, I'm going to look at some longer term Vanguard bond ETFs and see what's in them and their maturity, their yields, all of that stuff. So let's go take a look. So on Fidelity, if you go to news and research, click fixed income bonds and CDs, you get this screen here. And so here are the rates going out to 30 years for different things like CDs, treasuries, corporate bonds, municipals, etc. Now, while the Fed was raising interest rates, you want it to be as short as possible so that you can take advantage of the higher interest rates that were likely to be around in 3 months or 6 months. So you would keep your money short in treasuries or short-term CDs. Now, with that lower CPI report, they're talking about possibly only one more raise of 1/4 point and then maybe a pause for a while and eventually some lowering if inflation doesn't come roaring back and if we hit a recession. So if you believe interest rates have now peaked and they will potentially go lower in the future, you may want to lock in a longer term bond or CD depending on your situation and when you need the money and your risk tolerance and all of that. Now, if you want to invest your money for 2 years or more, the best bet looks like CDs because a 2-year is paying around 4.85% compared to a US Treasury, which is only 4%. And a AAA corporate is less than 4%. Right? Even the 3-year CD is about 1.15% better than a US Treasury. And even 5 years are 4.85 compared to 3.54 for a US Treasury and 3.74. And of course, this is FDIC insured and treasuries are considered risk-free, so it is about the same. If FDIC defaults, then T-bills will probably default or vice versa. But there is real risk in corporate rates, right? So why would you buy this when you can get this FDIC insured? You wouldn't. But if you are really thinking that this is the absolute peak on interest rates and inflation is going to do nothing but come down and go back to 2%, and we're going to have a recession and interest rates are going to be low like they were for the last 10 years or something like that, then you might be considering going out longer, like 10 years, 20 years, 30 years. The problem with that, though, is 10-year is 3.4, 20 is 3.82, 30 is 3.69, even AAAs are 4.36. And with the way we're spending money in this country, I can't see that inflation is going to come down significantly, especially over a 30-year period. So to me, lending out money at 3.69% for 30 years doesn't make a lot of sense. But for some other people, it might. I don't know. Now, going out 9 months or longer, it is better to buy CDs rather than treasuries because they pay a good amount more. Of course, CDs are not liquid. You can sell T bills whenever you want. CDs, there is some kind of secondary market, but it is very illiquid. So if you're buying a CD, make sure that you really are not going to need to touch it before it matures. So if you're convinced that interest rates have peaked and you want to go out a little longer term, but maybe you don't want to buy CDs for some reason, let's see what kind of bond ETFs you can buy at Vanguard that go longer term, like maybe 3, 5, 10 years or more, and how they compare to these rates here. Now, one thing to keep in mind that even if, say, the Fed starts lowering interest rates or something like that, they are not necessarily going to materially affect longer term rates like 10-year, 20-year, 30-year. Think of it like this: 3 month is like you being on the shore of a big lake, and the Fed makes a ripple in the lake shore by dropping a big boulder right here at the shore, right? The ripples are going to be the most right here, a little less over here. The farther it goes out, the ripples from that rock are going to be felt a lot less and less. And so in a 20 or 30-year period, or even in a 10-year period, the Fed is going to be causing different kinds of ripples by raising and lowering interest rates over many different times. And so what they do right now should not really affect 10, 20, 30-year rates by just what's going on today in the Fed, because as you know, some economic report can change the whole calculus of what they're going to do next. So let's take a look at some bond ETFs on Vanguard. A lot of other companies have bond ETFs, but Vanguard has some very low expense ratios. So their most popular bond fund is BND, Total Bond Market ETF. So let's choose that, and let's look at some longer term bond funds like this: the long-term corporate bond and the long-term government bond, as well as this extended duration Treasury ETF. So compare, right? And just notice that the risk potential is 2, 3, 3, and 5. And so the more riskier it is, the more sensitive it is to interest rates going up and down quickly. So the EDV is the most sensitive. And you can see that here in the performance, the 1-year performance, as interest rates have gone up a lot. The BND lost 4.7%, while the VCLT lost 11, and the long-term Treasury ETF lost 16, while the EDV lost 23.8%. And so the 30-day SEC yields are 4%, 5.3, 3.72, and 3.79. So now let's look at them a little bit more in depth individually. And here the expense ratio is 0.03% compared to 0.58% for similar funds. This is a huge difference. When you are only getting 4% on your money, you're keeping another half a percentage point in your pocket by using funds that have very low expense ratios. So keep aware of that. Now, this ETF has about 10,000 bonds in it, a yield to maturity of 4.8%. The average coupon is 2.9%. The average effective maturity is 8.9 years, and the average duration is 6.5 years. Now, maturity and duration are different. This is how many years on average the bonds have till they mature. This is an indication of how sensitive this fund is to interest rates going up or down. And it is a huge fund that has almost $300 billion under assets. And so let's see what's actually in it. If you look, 67% is actually US government, only 3.6% is AAA corporate, 2.9% AA, almost 12% A, and 14% triple B. So you got to be careful of this because a lot of funds add junkier stuff. It's kind of like putting filler in hamburger meat and then selling it as hamburger meat, because the junkier rated stuff, the higher interest it pays. And so it makes the fund look more attractive that it has a higher interest rate. So this is not bad. It's mostly government bonds and, not that many triple Bs, right? And the majority of the bonds mature in between 1 to 10 years. It's 70% of that there. And so some of the bonds here: Amazon, Amgen, AbbVie, American Express, Abbott Laboratories. So this is a decent all-around fund if you want to have some longer-term bond exposure, but you don't want to be exposed that far out into the future. You might go with something like this. Now, for longer-term corporate bonds, you have VCLT with a 30-day SEC yield of 5.31, which is pretty high, but we'll see why that is in a minute. But the expense ratio 0.04 versus 0.48. So about 1/12 of similar funds, right? They have 2,700 bonds, yield to maturity 5.6, which is pretty high. Average coupon 4.6, which is pretty high. Effective maturity 22.9 years. Average duration 13 years. So it has about twice the sensitivity to interest rates as the BND ETF. And doesn't have that much under assets, $5.8 billion. Let's see what's in this thing. So here's the thing. It looks like, hey, 5.3%, this is great, right? I should just buy this. But you see, AAA only 8.9%, almost no government, right? But A, 38.8%, triple B, 50%. So this is why this has such a high interest rate, because fully half of it is triple B, which is a pretty low rating. So they have to pay higher interest to account for the low rating because they have a higher risk of default. And you see, most of the maturities are in the longer term. 20 to over 25 years is 65% of it. And they hold things like Anheuser-Busch, AT&T, Boeing, AbbVie, Bank of America, Apple. Now, because this is very long term with a higher duration, this thing fell 25% in 2022. And so it is relatively volatile because of the long duration. Plus 13, plus 23, minus 7, plus 11, minus 5, minus 5. So you would buy something like this if you are really committed to being in a long-term bond fund and you really think that interest rates have peaked for a very long time to come. You might buy something like this. You get the extra kicker of the 5.31% because it has some more BBB type filler in the hamburger, so to speak, to give you a bigger return. And so that is a risk because you see when interest rates move a lot, this thing could take a big hit. People don't expect to lose 25% on a bond fund. But 2022 was an anomaly. So even the BND, which has a shorter duration, lost 13% during 2022. But you see, the returns on this are a lot less volatile than the longer term VCLT. So now let's go to VGLT, the long-term Treasury ETF, 30-day yield 3.72, expense ratio 0.04 versus 0.27. That's very good, obviously. It only has 74 bonds, yield to maturity of 4%, average coupon 2.7%, average effective maturity 23.1 years, and average duration 16.1 years. So it is more sensitive to interest rate moves than even the VCLT. Assets under management, 8.5 billion. And so because it has a longer duration than the corporate bond ETF, it was down 29% in 2022, right? And so its yearly returns, -5, +17, +14, are a lot more volatile than the BND. So what's in this ETF? 100% government. Right? And the majority is over 20 years, right? 64% or so is 20 years or more, and another 35% in the 15 to 20 year category. So this is a very long-term bond. And so you see, this is everything that's in it. It's just treasury notes and bonds. So who would buy this ETF? Well, if you are really long-term, but you want higher quality, Government, less risk supposedly, but because of the longer duration, it's actually more sensitive to interest rates, but less sensitive to credit defaults by companies, obviously. So again, this is a long-term thing. If you think interest rates are going nowhere or heading lower for a long time to come, you might get this. Now, lastly is EDV, the most risky and probably the least appropriate for most people. 30-day yield, 3.79%. So this is strictly US Treasury strips 20 to 30 years. And what that means is they strip out the components of a bond, which is just a principal payment at the end and interest payments twice a year all through the term of the bond. And they sell those separately. So you can buy just interest payments or you can buy just the principal amount at the end of a term. Has a very low expense ratio and only has 81 bonds, yield to maturity 4%, average coupon 4.7%, effective maturity 24.9 years, the longest out of all of them, and average duration 24.4 years. So very long and very sensitive to interest rates moving up and down. Only 2.4 billion in assets. So because of this really long duration, you see this thing fell 39% in 2022. But it has years where it's up 23%, 18%, 14%, down 5%, up 44%. This thing is very volatile. And it's 100% government bonds, and the effective maturity 50% is 20 to 25 years, and the other is over 25 years. And so these are the holdings, right? So this one is a treasury strip of the principal, right? Here's another one, but here's one, the treasury strip of the coupon. So it has both. So who would buy this thing? Not most people. You would only buy this if you were really certain and were trying to lever your opinion that interest rates were going to fall a lot very soon. Then you would buy this because you would have the most upside appreciation if that happens. If it doesn't happen, or if interest rates go even higher because inflation is not whipped yet, then this could have more years like this of minus 30 or something along those lines, minus 20. So guys, I hope that gives you some potential ideas of what types of bond ETFs you might want to look at if you are going to look at longer term bond funds. As always, this is not a recommendation to buy any particular bond or bond fund. Do your own research. I hope you like this one. I'll see you in the next one. Thanks for watching, guys.